Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on Newstalk 780 KOH. It is a pleasure to be with you and a pleasure to be with my co-hosts. Around the horn we shall go. Mr. Cory Edge, Edge Reality. How you doing, Big C?
I'm doing fantastic, sir. How are you?
Very well, thank you. A little bruised, a little beaten, a little battered, but all good.
Love it.
Dwight's laughing because that's always him too.
Yeah.
I don't know who got hit worse, you or me today.
Jeez.
Holy moly, it was a tough one. All right, folks, we got a lot of things to talk about today. We had a pretty doggone good sell-off in the market today. I want to, of course, give you all the reasons behind it and give you a little bit of advice, what we see going on, what you may want to be thinking about doing with your portfolios. So we'll get to that initially. Then we're going to get into our real estate topic. We have two topics we're going to get to. We're going to start with one, and potentially we may not get to our second one because I think this one is going to boil Dwight Millard's blood, and I hope to get him fired up. It's been a while, and we can just talk about it because it is very, very fascinating. What I'm talking about is there was a really, really interesting article in the Wall Street Journal today, and it's titled "Builders' Cheap Mortgages Are a Bad Deal for Home Buyers. People who borrow from a builder are more likely to overpay for their property and be underwater after they move in." Folks, this is a completely different take on what we've been talking about. And thanks to Dwight and Cory always telling us about, the incentives that these national home builders are giving to lure you into buying their home, right? And you're like, wait a minute, how can they offer a 4% mortgage and the rest of the market's, almost 7%, north of 6, but actually closer to 6.5 than 7. But the bottom line is, how in the world can they do that? And so Dwight's given us some explanation on it. But we're going to go a little bit deeper into this topic at this point, because believe it or not, there are some risks that some very influential people have delved into and went, oh, wait a minute here. The values of these homes that these people come in, they get the dirt cheap mortgage subsidized by the builder. The value of these homes tend to be underwater more than someone just getting, I'll just call it a regular mortgage, like from someone like Dwight or something similar to that. So we're going to go into that because many of you may be looking at that scenario. I'm not saying it's a bad one, but I think, again, we need to let you know there's, like anything, it's not always what it cracked up to be on the surface. So then we get through that. Then we're going to try to get into what we call the Great Migration. There's a lot of people moving around these days. And we want to talk about the pluses, the minuses. A lot of people, of course, moving for various reasons. But what's involved with it, right? What are the costs? What are the pluses? What are the minuses of it? And so we'll get to that one. But like I said, I want to focus first on the builders' cheap mortgages. Dwight, I'm surprised you were able to keep your mouth closed while I was mentioning that. I know it's got to fire you up on that whole situation.
Well, John, the reality of it is, it's one thing when you're on the other side, when you're the preferred lender, but the reality of it is that I've always been integrity based. But when you get a joint venture and affiliated, a lot of these big companies have their own mortgage company, and there's only a certain amount of pie that can go around. You can't cut it and slice it into the pieces they want. So it makes it very difficult and I'm going to just say it makes it very difficult for a preferred lender, actually a builder-owned lender, to compete because they've got to share the pie. I mean, and it's a big pie. They got to share it. And so when somebody comes in, and it's really unfortunate because it's misleading to the consumer, they're not getting the best deal. They're not getting, but John, I can't go into
this article said exactly.
I can't go into a builder that has a preferred lender and start pitching rates because I'll get kicked out really fast, right? I got to go with some products. I got to give them products that they don't have or that I can specialize in. That's the only way you're going to get in because they're going to be very protective of that because it's a money thing. I mean, Cory was involved in it. I ran a joint venture in Reno with a very large builder and it worked. But we did it right. We did, they get so nasty, John. If there's an outside lender typically that comes in, it's just quite amazing.
I cannot imagine the politics that are involved in that situation. Real quickly before we get to the stock market side, because obviously there's a lot to talk about with this topic. Explain to the audience when you say preferred lender. No one knows what that is.
So there's two types of arrangements, or there may be three, but let's just the first one is that the builder owns part of the mortgage company. So there is a vested affiliated business arrangement in that, and you have to disclose that either the builder owns it. There's a monetary connection there, Or then there's a preferred lender, either just straight up a preferred, hey, I'm going to make, Dwight, I like you. I'm going to make you the preferred lender. So everybody's got to get pre-qualified from you. What can you give us? And it's always that kind of thing.
Mm-hmm.
And, that is the other way. And a lot of builders will have maybe one or two preferred lenders that not a monetary, it's not a monetary setup here. It's just, hey, I like the way you do business. We take our friend Peter Listener. I mean, a preferred, he usually carries two preferred lenders. He's got a pretty good pulse on the lenders out there. And so you try to, the best you can, direct them that way. You cannot close. A builder cannot force a borrower to close with a specific lender. That's illegal.
I was wondering about
that. But they'll give hard incentives and soft incentives to drive them your way. And that's what's going on. It's really unfortunate, John. I have a story I can tell down the line that, that on a particular one.
Please. Yep. The stories.
Okay. Well, so I would work with...
No, not right now.
Oh,
not right now.
Oh, okay. I was anxious. I was ready to go.
I told you, Cory.
Yeah.
I told you.
I know.
I'm going to get his blood boiling. I promise you.
I have lots of stories, but one particular.
All right, perfect. Cory, anything you want to add to that before I get to the stock market side?
No, it'll be interesting to talk about, but you can't have your cake and eat it too, right? You're not going to get a price reduction and one of these 3% mortgages unless the market really goes down. So We'll get into the details.
Absolutely. All right, so it's going to be interesting. All right, guys, let's get to the stock market side. What the heck happened today? So I'm going to take you back to this morning. Well, actually, let's go back to the last couple of days. So 2 days in a row, we had record-setting days on the Dow Jones Industrial Average. We saw a little bit of weakness on the NASDAQ side of things. S&P was just, barely budged, a little bit on the positive side. But, just going back to yesterday as an example, right? We had a 326 point gain on the Dow, but the NASDAQ was down 62. S&P was up 4. Day before, that's when we had the over, 504 or so gain on the Dow Jones Industrial Average. So, in 2 days, we've almost gained 1,000 points on the Dow. Just unreal. Now, why? Why was the Dow strong? Why was the NASDAQ weak? Well, as Jason and I mentioned on the show yesterday, we're going through this rotation right now, right? Where the market's trying to cut the ties a little bit with AI and with tech and rotating into other areas of the market, consumer staples and utilities and healthcare and so on and so forth, which is always a healthy thing to do. Does it usually last? What we've seen recently is when these rotations begin, it starts to be a sign that there's something going on under the surface of the market and it's starting to weaken. It's very difficult for me to believe that someone wants to give up. I'll just pick NVIDIA as an example, right? And, stocks up whatever percent year to date to go, hey, I want to go buy a utility or Coca-Cola or a Nike or something along those lines. So sometimes it's where the algorithms and the institutional managers will go, hey, you know what? Tech's overvalued, right? We've used this term a million times. It's overvalued. So let's take some of the chips off the table in the tech sector and let's move the money over a little bit into, again, the rest of these areas of the market. And that's what we've experienced these last couple of days. Hence why the NASDAQ's been down and the Dow's been strong. Because remember, the Dow has 30 stocks. There's some tech. There's a little bit of everything in there. All right. So now let's go into today. Well, we all knew very confidently that the government was going to that Trump was going to pass and get the government open, sign the new legislation or the new bill, and everything was there. A lot of people, guys, were asking me and saying, is this going to be a big rally for the market? Well, if I go back to yesterday morning on the stock updates, and I think even Monday on the show, I said, look at the market reminder. The market is a forward-looking indicator. It knows pretty doggone well that the government was going to reopen. So it's already priced in, just like when Dwight and I talk about rates and things, it's already priced in. You cannot outsmart the market. It just will not happen. No matter how good, no matter how much money you have, no matter how much experience, no matter how many degrees you have, you will never, ever outsmart the stock market. Okay. Now we fast forward to today. We were a little bit weak in the pre-market session. I see my notes here. My first report at 523. Dow was down. Dow futures down 76. NASDAQ's down 48. And just a 12-point loss on the S&P. All right, so we kind of drifted. But now, going into Dwight's world, all of a sudden we started to see an uptick in bond yields and a little bit more and a little bit more. And before we know it, bond yields, moved very strongly, as we'll discuss when we come back, tell you what the 5-year or the 10-year did, and Dwight will tell you what the mortgage side did. But what happened? So what drove this market down was the Fed members. And it wasn't just one, but it was a number of these Fed members today that really started to get the market nervous, and nervous in regards to, are we going to get our next interest rate cut? Okay, so let me kind of go down the list very quickly before we go to break. You had Boston Fed President Susan Collins, who is a voting member of the FOMC. Yesterday evening, after the market closed, she said, quote, let me rephrase this, quote, it will likely be appropriate to keep policy rates at the current levels for some time. Ouch. Okay, strike against the December rate cut. Then we had St. Louis Fed President Alberto Muzalam, voting member also. He said the Fed, quote, needs to lean against above target inflation, meaning no hurry to cut rates. And then Cleveland Fed President Beth Hammack, who is not a voting member this year, but she will be next year, she echoed a similar sentiment, saying policy should remain, quote, somewhat restrictive to continue putting pressure to bring inflation down. So there you have 2 out of 3 voting members, one that's going to be a voting member next year, saying, bottom line, it's not time to cut interest rates. So what we saw happen, guys, was very simple. A month ago, there was a 95.5% probability that we were going to get an interest rate cut in December. Yesterday, that probability, according to the CME FedWatch tool, was 62.9%. Today, 51.6%. So all it takes is, again, and it all started, of course, when Jerome Powell had his news conference and, was adamant that, it's no guarantee that we're going to give you a December interest rate cut. So now everybody's freaking out about this. And that is what caused the sell-off today. And I'll tell you exactly what those numbers are when we come back. Let's turn it over to Kristen Snow, right now, Traffic Center. Kristen.
Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of Highlands Mortgage, Cory Edge of Edge Realty. All right, so here was the bloodbath today. A 798-point loss on the Dow, down 1.65%. Yeah, you put it on a percentage basis, not bad. 47,457 was our closing level. NASDAQ lost 536, 2.29%. S&P down 113, or 1.66%. Again, the very, very broad-based selling, obviously. Told you the reasons again, market rotation, getting out of tech, just concerned about a lot of different things. If we look back over to the Dow, we had big pressure on Disney. They had an earnings miss in the pre-market. Stock finished down about $8.95 to 107.70. Goldman Sachs, along with other banks, were down. Goldman down $31.45. NVIDIA down $6.90. Caterpillar, again, another one that's just been on fire, down $19.48. JP Morgan down $10.12. I guess the reason I'm laughing is, it was last night, guys, that, Jamie Dimon of JP Morgan and David Solomon of Goldman Sachs and all these major Wall Street bank powerhouses, their CEOs had dinner with Trump. So maybe something was said or I don't know, leaked or something. I don't know. But that kind of cursed them, I think, there. All right. So there's that. Now we're going to get into this story about, again, these publicly traded home builders and the buy downs. But before, a story just popped up on CNBC, and we want to mention this. And I'm going to read this, guys, real quickly, and then we're going to get your opinion on this because there's some info here. And this article is stating that new foreclosures have jumped 20% in the month of October, a sign of more distress in the housing market. So listen to this, folks. Foreclosure filings climbed again in October after sitting at historic lows in recent years, according to new data released today. While the numbers are still small, the persistent rise in foreclosures may be a sign of cracks in the housing market. There were 36,766 U.S. properties with some type of foreclosure filings in October, such as default notices, scheduled auctions, or bank repos, according to Adam, a property data and analytics firm. That was 3% higher than September. But here's the number, 19% higher than where they were in October of 2024. So significant jump there. And by the way, this is the 8th straight month of an annual increase, according to Adam. Foreclosure starts, which are the initial phase of the process, rose 6% for the month and were 20% higher than a year before. Completed foreclosures, the final phase, jumped 32% year over year. Quote, even with these increased activities remain well below historic highs, the current trend appears to reflect a gradual normalization in foreclosure volumes as market conditions adjust and some owners continue to navigate higher housing and borrowing costs, according to Adam CEO Rob Barber. The areas hit were Florida, South Carolina, and Illinois. They led the nation in foreclosure filings. On a metropolitan level, Florida's Tampa, Jacksonville, and Orlando had the most filings, with Riverside, California. Ooh, that's a bad sign. Riverside, California, and Cleveland rounding out the top 5. Looking specifically at completed foreclosures, Texas, California, and Florida had the most, suggesting those states will see more inventory coming on the market at distressed prices. Still a very strong demand for homes, especially in lower price ranges, so it's likely that foreclosed properties will find buyers quickly. Cory, I don't like that about the California side. Here we had Riverside and then just the state of California and the completed foreclosures. And the reason I say that, and correct me if I'm wrong, but the way we always gauge things here in Northern Nevada, how does California do? We tend to follow right along there. They're strong, we're strong. They're weak, we get weak. But usually there's a lag. Is that still the case?
Yeah, I mean, it should be. And there's so many different factors here. We'll get into the 2-1 buy downs and people stuck. But if you look at pricing over the last 2 years, you're kind of stuck. The pricing has not shifted, right? Like the average price is pretty close to where it was a couple years ago. So if you had some of these buyers, whether they bought brand new or bought resale, that got into any type of mortgage where the hope was they could refinance in 12 to 24 months at a lower cost, they haven't had that opportunity. The value hasn't gone up, the rates haven't gone down, they're stuck. And then I don't want to get Dwight too on fire, but then you got rising taxes, rising homeowners insurance, right? And the other thing to remember about the other thing to remember about final foreclosure. So the first step is the notice of default, then it goes through, then the notice of sale and the foreclosure. So when they say completed foreclosure, typically, not every time, but typically that means that person was over levered for that property. Otherwise, they would not have let it go to foreclosure. They would have sold it in the regular market. So it's just an excessive debt, if that makes sense.
Right, right.
Well, I'm surprised, John, you haven't seen Cory. I mean, short sales versus the foreclosure, right? I mean, if you're a little bit off, but to Cory's point, John, this should be disturbing for everybody because that means you had no equity. And Cory's absolutely right. If anything, we've had stagnation values and rates have stayed, or now if you did a buy down, went up. So, and now you probably have more credit card debt. You don't qualify like
maybe you don't have a job.
Maybe you don't have a job. I mean, it's tricky.
There's a lot of scenarios coming there. Cory, I want to go back to your point. That was interesting. Okay, so your typical foreclosure process is what, about 90 days, 120?
In Nevada, 120. If they go as fast as they possibly can, 120 in Nevada.
Okay, so we're talking 4 months to sell a property. So why do you think they're not selling? Because they just don't have the equity in there to sell it?
More than likely. So
that means they're newer buyers then.
They could be newer. They could have high HELOCs. They could have other debt. The other thing that you don't see, because they don't talk about it a lot, there are a ton of players in the alternative financing realm. I mean, you don't have to go to a guy like Dwight now to get a HELOC. You can go to the computer and get crazy HELOCs and these things. And so it's hard to put your finger on how much debt is actually on these houses. But I've been through enough of them that every once in a while, somebody just doesn't know the value. They let it go and like, oh man, I had value in that, but it foreclosed. But most of the time, if it goes through the foreclosure process in this market, it was way underwater. That's why it got there.
John, consider this maybe the trend too. Think about in the subprime days, mortgage companies, builders, everybody sold, hey, get into it this way and you can refinance, down the line. Oh, yeah. Right. So now we have the newer version of subprime is called non-QM, right? Stated wage earners, bank statement loans, 1099, they've opened them up. So if you took that on the auspices that I'm going to refinance like we did back in 08, 09, well, here you are. You can't afford this, you can't afford this 1099 loan program. And here we are. And now what do you do? What do you do? I mean, you can't, you just can't refinance.
Real quick before we go to break, Cory, are you seeing anything locally with an uptick in foreclosures?
To be honest with you, I have not looked as close. So I get a report every week that has NODs and notice of defaults and notice of sales. And it was so small for so long that I stopped opening it, but I'll start looking at it again to see
that'd be interesting to start
what's happening.
Okay, perfect. All right, we come back. We'll get into this situation. Speaking of, underwater and stuff, Can you get underwater by taking a buy down or a dramatically reduced mortgage from one of the national builders? This great Wall Street Journal article today says, yeah, watch out. Be careful. It's not what you think. So we'll touch on that with the boys. First, let's turn it over to Jack Saban, News, Traffic, and Weather. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Cory Edge of Edge Realty, Dwight Millard of Highlands Mortgage. Once again, we finished down 798 on the Dow. Yes, you heard me correctly. 536 loss on the NASDAQ, down 113 on the S&P 500. All right. So this article again, that was, I may have said Wall Street Journal earlier. I apologize. It was in Bloomberg. Builders' cheap mortgages are bad or a bad deal for home buyers. You may be thinking, wait a minute, I can go get a mortgage for, 3.5, 4.5, significantly lower than 30-year money that you'd get from a traditional lender. How can this be bad? Well, you got a lot to learn, folks. We just had a great discussion during the break, and I told Dwight, it's like, hold on. I want you to tell the audience this. But first, let's hit the commodity side and then hit these rates real quick. Okay, oil 24-cent gain today, 58.74 a barrel, down $18 on gold, 41.95 an ounce. 5 basis point increase, Dwight, 10-year, 4.11. How'd we do on the 30-year?
So 30-year fixed, John, 6.34. Today I had this discussion with somebody today. We were at 6.17 before the Fed's latest cut. So, your government's FHA and VA are just above the 6%. So, we had them inside the 5s pretty well, or inside the 6s, rather.
Yeah.
And now here we are back above the 6s. So definitely headed the wrong way.
Yep, headed the wrong way. As we said earlier in the program, the last segment, you had 2 Fed members today saying, basically, we don't want to cut rates, and the probability came down. And then that third member is not a voting member yet, saying the same thing. So that's what spooked the stock market and brought these yields up. All right, guys, let's get down to this very interesting story, because Dwight's going to take us behind the scenes as well as Cory. So here's a situation. Bargain mortgages originated by builders are helping more people get into a property sooner, right? And cheaper, and so on and so forth. But there's a hidden cost, which is inflated home values, which result in underwater loans. Now, we just told you before we went to break, foreclosures are starting to increase. Big home builders are offering the cheapest mortgages in the market. America's largest home builder, Lennar, right, Dwight? You said it was Lennar?
No, I think it's D.R. Horton.
Or D.R. Horton.
But Lennar's right behind him. Yeah.
Offering a rate at 3.99% on a 30-year. Now, you just heard Dwight say, 6.34 is the national rate. So you're going, wait a minute, how can they 3.99? How does this happen? D.R. Horton's latest promotion in certain housing communities is a temporary rate buy down, where buyers get a 0.99% mortgage for the first year, rising to 3.99% by year 4. I've never even seen that one, Dwight.
Yeah.
Really? They start out at 0.99 and top out at 4 in 4 years?
Yeah. Woo. Yeah. Imagine the cost on that, John.
Yes, and that's what you're going to enlighten us on. All right, so large builders can offer these eye-catching deals because they buy forward. This is where it's going to start getting interesting. Okay. Large builders can offer these eye-catching deals because they buy forward commitments from lenders, which is an agreement to buy mortgages in bulk at below market rates.
Right.
They then allocate low-cost loans to individual home builders or home buyers, excuse me. Now, Dwight, let's stop right there. Okay. They buy forward commitments from lenders, an agreement, which is an agreement to buy mortgages in bulk. Put that in English for the rest of us.
Well, what they're doing, John, is they're going to go buy a block of money, whatever it is. Let's just say $10 million.
Give us an example.
Okay, so I've got. Let's just say I have. I'm going to just use just a single track. Let's just say, and I got $5 million of standing inventory. Well, I'm not going to go buy $5 million because they're going to put a little money down. So maybe I'll go buy $4 million of forward commitment. I'm the builder. I, in essence, become the lender because I'm they have a mortgage company. So I'm going to go buy the $4 million. I'm going to discount it. I'm going to spend a lot of money because I got to attract you. I can't buy it at current market. Why would I do that? So I'm going to go buy $4 million to sell my $5 million of inventory. I'm going to go $4 million. I'm going to spend a lot of money up front to get you to a number that's lower than the market and still have the flexibility to add more case by case to the borrower, if that makes sense. So let's just say, like you said, let's say the rate's 6. I'll go buy 4. 4 is going to be really expensive, but I'm going to go buy 4. But because
4 million or 4%?
4%. I'm going to buy the 4 million at 4%. I've already now destroyed.
Stop. We got to spoon feed all of us. So you're buying 4 million at 4%. How are you getting it at 4%?
I just
When everyone else is getting it 6.
I just spent a lot of money for it. Let's just say it was about 4 points. So what is that? 160,000?
You the builder then are buying down, just
Correct.
like if Cory went to
Yes.
buy a house
Yes.
with you and you're buying
Yes.
down. Okay,
Yes.
you left that point out.
Yes.
All right, so now it's making sense. So you go to Wall Street, or your like you said, your wholesale
Yeah.
lenders is what you
Mm-hmm.
told me during the break.
Mm-hmm.
You go, okay, guys, I need $4 million. I'm going to pay you 4 points, so therefore my net cost to borrow that money as the builder is 4%.
Correct. Let's
This
just use that as a
example.
number. Yeah. So I'm going to pay
Beautiful.
$160,000. Yeah.
By Ford contract. Okay. Keep
Right.
going.
Now I have 4% to go out and offer. And what's nice about buying it down in the forward, John, is I still have all my concessions available if I needed them on a case by case with the borrower. I mean, so I have not used that concession. That
Okay, you have concessions available on a case by case. So you as the builder, you just spent what, $400,000, right, to buy this chunk of money down, right?
Right.
You spent 400,000, 4%.
No, I spent 4 points, 160,000. I spent 160,000 in our scenario to buy 4.
Okay, so not bad leverage. Okay, I missed it.
Right.
Okay, so not bad. So you spent 160,000 to control $4 million.
Correct.
Right? It's kind of like derivatives in the stock market.
Correct.
Okay, so you're not into it all that bad in this example. All right. So now what you were saying is you can use those concessions. So if Cory comes to you and Cory's just a real stickler and he's like, no, I love your, 4% mortgage you're offering me, Dwight, but man, I want some granite and I want all these upgrades.
Closing costs, whatever. Mm-hmm.
Right. That's the little bit of fluff that's left over.
I can still I can still dip into my concessions. Yeah.
Following you now. Keep going.
Well, so then what happens then is I'm attracting and knowing that I can buy it down even further if I need to, but I'm already ahead of the game. But I'm going to do this in lieu of, to this article's point, instead of reducing prices. Even if the market around me is dictating that the values have kind of stabilized or whatever, my trade-off is lower interest rates to you than a lower house payment. You get more bang for your buck, John, by lowering the rates than you do discounting 10,000 off the price. So,
and Wall Street loves you. I'm going to throw my 2 cents in now.
Yeah.
Wall Street loves you, Dwight, as a publicly traded builder, because in this example, you only spent 160,000 instead of spending 2 million or whatever to offer incentives and lower rates, right? You're leveraging it. So therefore your top line revenue is not being impacted by dropping the price of your home, and therefore your earnings per share doesn't get hit and your stock should do better.
So John, in real life, that's why they don't allow you to go outside to another lender, because at least they can make up a little bit in the loan side of it. And, maybe, on when you sell out, you get your service release premium. So if you did all of that and you lost all your loans to an outside lender, you're really in trouble. Yeah, you're really in trouble.
Okay, so when we come back from the break, let's hit the final point of this. It's been fascinating. We'll hit the final point of this, guys, and that is they also have an advantage over lenders like yourself, Dwight, because this thing called a concession and the limitations that Fannie Mae puts on you, but not quite on the builder. Right. Let's wrap it up with Kristen Snow right now, Traffic Center. Kristen, welcome back to the Jon Sanchez Show on News Talk 780 KOH. Cory Edge of Edge Realty. Phone number, sir?
673-6700.
Thank you. Dwight Millard, Home Lens Mortgage.
Highlands. Yeah.
I almost
did
it.
All these years, John, I'm proud of you. I wish I could just call it Millard Mortgage. Keep it easy.
2 minutes left and 10 minutes of stuff that I want to ask you.
240-2022.
Perfect. Okay. All right. So once again, we are having a fabulous discussion in regards to taking you behind the scenes why these home builders, cheap mortgages are a bad deal for home buyers. Okay. So Dwight gave a great explanation how they go out and they basically buy the money down, and therefore they can pass that on to you so they can move inventory. Now, Dwight, we get into 2 things we got to make sure we get done before the show ends. Number one, let's talk about concessions, right? You guys, Cory, you always talk about concessions. There's a different set of rules for these home builders versus a small guy building a home.
The concessions themselves, FHA, VA, and conventional, are all the same. Where the builder wins or they have the benefit is they're utilizing some of their buying power inside the commitment, and then they still have the concession on the backside to still offer to you. Okay.
So
you lost me.
So here, and correct me if I'm wrong, Dwight. In those loans, the seller can give up to 9% concession, call it money, towards the buyer to help them. 9% is the magic number. Builders fall,
Upgrades, buy downs.
not even really upgrades. I don't think it's mostly cash, closing costs, those kind of things.
Yeah.
But
Buy downs.
the builders have to play by the same rules because these are FHFA rules. When they go to buy these forward commitments for these hundreds of thousands, that doesn't count inside a concession. They still have
Can
9%
use the concession.
to spend.
Well, typically, John, what they're advertising is FHA, and Cory under FHA at 6%.
Gotcha.
So, John, I still have, so think about this. Let's say I paid 4 points in our scenario to get you that 4%, right?
You're the builder. Yeah.
Right.
Okay.
I paid 4. Okay. I give you another 6. That's 10 points I gave you.
Right.
How do I compete with that?
Right, exactly. Well, here's what's interesting. According to the article, these big builders, again, they can give much more generous incentives to the buyers because of these forward commitments, like Cory said, that are not counted toward the seller's commission. Lennar gave incentives equivalent to 14% of the average home price in the latest quarter, an effective price cut of $64,000 per property, and the highest level of concession activity.
So, John, if you use 6%, and what was that number, 14?
14.
Then they were paying 8 for the forward.
Okay, right.
Yep. Okay. Which is huge. That's double the amount.
Yeah. So they doubled the amount versus what someone else can do. But to the final point, which is because of this, an effective price cut of $64,000 per property is what this example shows. So this is why, again, if you have 2 properties in the same housing tract, let's say they're identical properties, one had the buy down and all these incentives we're talking about, and one doesn't. Well, theoretically, the one that has all these incentives because it's all financing is really worth less than the other property.
So here's an easy way to think about it.
Yeah.
So if you go out to this new house tract and you buy it, and that builder, knowing to you or anything else, gave $64,000 in financial incentives to get your rates down and get all this stuff. If you have to sell that house 6 months later, you can't go get the same buy down. You don't have $64,000 to give to the next buyer. You're going to have to reduce your price to get down to compete against the market. That's why you're underwater automatically from the jump in these things, because
It's all lending though. Why does it affect the home price? That's where I'm stuck.
Because you probably wouldn't have bought it without these incentives. You would have negotiated a lower price. But what the builder's saying is, no. We're leaving the price alone. We're going to give it to you on the back end. I guarantee that when cash buyers come in, they're not giving them $64,000. They're giving them some other incentive because they need that top line, because of Wall Street, to stay flush. So that when people like Richard Lace come across to appraise it, it all looks copacetic. It doesn't have jumps up and down because then Richard can't appraise it.
Right. Yeah, main thing is you don't want property A to be sold for $64,000 less than property B, being all things equal.
not in the time of Zillow, right? Because the person buying is going to be like, well, no, I see Zillow. You just sold that one for $64,000 less.
Yep.
That's the deal I want.
Yeah.
Okay, boys, music's playing. Cory, your final advice on this, and then same with you, Dwight.
Just be careful. Read all the documents. Talk to somebody like Dwight before you commit to these things, because it's a lot of smoke and mirrors.
Yeah, really. Dwight?
John, I give free advice. So, just reach out and I can guide you through it. But there is a little bit, you're not getting anything for free. I mean, it's costing you somewhere. Yeah.
Fascinating topic. Again, taking you behind the scenes. You only can get it on this show. Great job, fellas. We will do it again tomorrow on the Jon Sanchez Show. God bless. Have a great afternoon.